The most dangerous Federal Reserve meeting is not the one that surprises the market. It is the one the market already knew was coming, and that still reveals the institution is trapped. That is where we are. People hear the words rate hold and think nothing happened. No shock, no dramatic pivot, no emergency cut, no stunning hike, just another central bank meeting, another press conference, another piece of polished language designed to project calm. That is exactly why this moment matters. Because when the outcome is fully expected and still carries enormous meaning, the meaning is not in the decision. It is in the lack of alternatives. That is the mother line I want you to carry through this entire story. The Federal Reserve is no longer choosing the best policy. It is being forced to hold the least catastrophic one. That is the line. Not confidence, not mastery, not wise patience, constraint. And once you see that, the whole market starts reading differently. Gold reads differently, bonds read differently, the dollar reads differently, silver reads differently. Even the boring language of the FOMC reads differently. It stops sounding like guidance. It starts sounding like containment. That is the real signal. Because a central bank with real freedom can still decide. It can tighten to kill inflation. It can cut to support growth. It can pause because it believes the economy will absorb the pause. A trapped central bank does something else. It holds because every visible path in front of it detonates a different part of the system. That is the stage we are entering now. Now let me show you the mechanisms. The first mechanism is policy paralysis. A lot of people still talk about the Fed as though it is standing above the economy with a clean lever in its hand. That was never fully true, but in earlier cycles it was true enough to matter. The institution could move rates up or down and still reasonably claim that the side effects were manageable. Inflation was lower, debt was lighter, global trust was broader, the economy was less politically fragile, the medicine was painful, yes, but still usable. That is no longer the world. Now inflation is still running above target. Oil has pushed through the level where cost pressure starts infecting everything. Growth has slowed hard. Unemployment is rising. Manufacturing is weak, and the debt load sitting underneath the entire sovereign structure is so large that any meaningful rate move now transmits directly into fiscal stress. That is policy paralysis. Cut and you reignite inflation while telling the market that political pressure, not the stated mandate, now governs policy. Raise and you intensify the debt. Service problem while worsening the slowdown and increasing the refinancing burden of a government already spending a fortune just to roll over what it borrowed before. Hold and you preserve the trap in place. That is not a menu. That is a cage. This is why I say nothing happened on the surface, because everything important happened underneath. The hold was expected. The trap it confirms is what matters. Now let us move to the second mechanism. I call it impossible arithmetic. When investors hear the Fed is trapped, many still process that as rhetoric. I do not mean it rhetorically. I mean it mathematically. This is where the arithmetic becomes impossible. The federal government has an enormous refinancing burden. Interest expense is already running at levels that would have been unimaginable in earlier decades. Debt issued in the zero-rate world is maturing into a radically more expensive rate world. At the same time, growth is no longer strong enough to make this feel temporary. And inflation remains high enough that openly easy money would be interpreted less like support and more like surrender. That is impossible arithmetic. This is what makes the current moment so different from a normal late cycle slowdown. The state needs lower rates more than the inflation data allows. The economy wants relief more than the bond market trusts. The public wants lower prices and lower borrowing costs at the same time, while oil is feeding the exact inflationary forces that make those desires mutually incompatible. This is why I no longer think the key question is, what will the Fed do? The better question is, which side of the trap becomes politically unbearable first? That is the only live question. And the answer to it matters much more for gold than the statement language ever will. Now let us move to the third mechanism. I call it balance sheet concealment. A central bank can hide many things for a while. It cannot hide the economics of its own balance sheet forever. This is one of the least understood parts of the whole story. The Fed spent years buying longer, dated assets in an emergency regime built for zero rates. Then the rate environment changed. Suddenly it had to pay far more on reserves while still holding assets yielding much less. The result is an institution whose economic reality looks far weaker than the public presentation suggests. That is balance sheet concealment. Instead of calling losses what they are in ordinary private sector language, the institution can rename them, smooth them, carry them, defer them. That does not solve the underlying issue. It merely changes how the issue is displayed. This matters because it reveals something much more important than an accounting quirk. It reveals that even the institution managing the reserve currency is now being dragged by the consequences of the regime it created. That means the Fed is not a detached surgeon operating on a patient. It is part of the same debt and duration machine that is now under stress. That is a profound change. And it is why I pay less attention to official phrasing and more attention to quiet behavior, backdoor liquidity operations, balance sheet classification, and anything that looks like money creation under a softer name. The name is not the thing, the behavior is the thing. Now let us move to the fourth mechanism. I call it quiet liquidity. This is where the story starts becoming explosive for precious metals. A lot of investors still imagine money printing as a loud political event, emergency headlines, giant announcements, a dramatic official pivot. But central banks have learned something over the past 15 years. They can keep the plumbing moving while trying to avoid the emotional shock of the old words. That is, quiet liquidity, reserve management, technical operations, market functioning support, treasury purchase programs under language that sounds like maintenance instead of rescue. All of this serves the same deeper purpose. Keep the sovereign funding machine alive without triggering the immediate recognition that the line between monetary management and fiscal support has blurred. That recognition matters enormously for gold, because gold does not wait for the central bank to say, "We are now officially trapped, and the printing is inevitable." Gold begins moving when the market concludes that this is where the process leads. It prices inevitability before language catches up. That is why people who wait for the press conference to feel alarming usually miss the most important part of the move. Quiet liquidity is the bridge between central bank paralysis and market repricing. It lets the institution keep functioning. It also tells the attentive investor that the system already needs help larger than its public tone will admit. Now let us move to the fifth mechanism. I call it succession risk. This is where policy paralysis becomes even more dangerous, because institutional independence itself starts entering the market's calculation. A central bank does not operate in a vacuum. It operates inside politics, even when it pretends not to. When the current chair is under open pressure, under legal and political threat, and when the incoming successor is publicly associated with easier policy, regardless of inflation conditions, the market stops reading the Fed as a purely technocratic actor. That is succession risk. It means every future decision gets interpreted through a second lens, not just what the data says, what the political system demands. If the next chair cuts, the market can read that as capitulation. If the next chair does not cut, the market can read that as proof that the trap is even worse than feared. Either way, trust gets thinner. That is what makes this so bullish for gold and so structurally dangerous for long-duration dollar assets. Because once the market suspects the institution is no longer free to defend the currency in the old way, it begins preparing for the world in which nominal stability is no longer the first priority. Gold loves that world. The dollar only pretends to. Now let us move to the sixth mechanism. I call it hidden fragility. Major bull moves in gold are never just about gold. They are about the hidden fragilities that the rest of the financial system is trying not to reveal. This is where private credit, private equity, stale valuations, rolling leverage, and the mountain of assets still priced for a cleaner regime all come into the story. When the economy slows and financing gets harder, the parts of the system that were kept alive through easy assumptions begin cracking. Sometimes the crack begins in banking, sometimes in housing, sometimes in sovereign debt. Sometimes in a giant shadow corner, the public barely understands until it is already leaking stress into the formal system. That is hidden fragility. And when it breaks open, the Fed does not suddenly discover a new tool. It reaches for the old one, liquidity, backstops, purchases, a softer word for intervention, then a broader word, then an emergency word if the cycle gets bad enough. This is why I care so much about where we are in the gold cycle. Gold does not need the crisis to be fully acknowledged. It needs the market to understand that the Fed's eventual response is constrained in one direction and inevitable in another. That is already happening. Now let us move to the seventh mechanism. I call it phase transition. This is the whole heart of the matter. A gold bull market does not move in one straight line for one simple reason. The buyer base changes, the motive changes, the speed changes. At first the accumulation is quiet, central banks buy. Sovereign allocators shift, institutions reposition, the public barely notices. The move is steady, important, and still deniable. Then comes the next phase, the moment when the broader market realizes why the smart money was buying in the first place. That is phase transition. It is the difference between a strategic accumulation market and a recognition market. In the first phase, gold rises because a small group of informed actors sees the monetary pressure building. In the second, gold rises because the rest of the market begins to grasp that the central bank has no clean way out. The first phase is institutional. The second phase is explosive. That is why I think this meeting matters so much. Not because the hold was shocking, because the hold confirmed the trap. And once the trap is confirmed, the transition toward the next recognition phase accelerates. That is the point where gold stops feeling like a quiet hedge and starts behaving like a verdict. Now I want to force the identity shift, because without it most investors will still hear this as one more gold is going up story and miss the framework entirely. Stop thinking like a Fed watcher. Start thinking like a trap reader. A Fed watcher listens to each meeting as if the language itself is the event. A trap reader asks whether the institution still has any policy path that does not intensify a different crisis. A Fed watcher waits for a surprise cut or a dramatic pivot. A trap reader understands that the hold itself can be the strongest signal, if the hold reveals that every other option is worse. A Fed watcher sees a policy meeting. A trap reader sees a balance sheet event, a debt event, a succession event, a liquidity event, and a phase transition event, all hiding behind one polished statement. That is the stronger identity. Because in a market like this, the obvious news is not where the money is made. The money is made where the hidden constraint gets priced before the crowd fully understands it. And now let me give you the operating system plainly. First, stop reading the hold as neutral. In this environment, a hold is information about constraint. Second, watch oil and core inflation together. They are what keep the cut politically and monetarily dangerous. Third, watch debt, service math, and refinancing needs. They are what make a true inflation fight dangerous. Fourth, pay attention to quiet liquidity under soft language. Central banks rename things when they are trying to manage reaction. Fifth, understand that the next Fed chair is not a side story. Succession changes how every future decision will be interpreted. Sixth, see gold through phases, not through day-to-day fear. The biggest moves come when the market starts recognizing why the first quiet buyers were there. Seventh, remember that by the time the public feels certain, the structural phase transition is already well underway. That is the heart of it. The Fed did not merely pause. It admitted, without saying so, that it is no longer operating from strength. That is why this matters. Now let me end where this really matters. You can look at this meeting and conclude that nothing changed. You can hear the hold, the careful wording, the usual central bank theater, and tell yourself the situation remains manageable because the institution still sounds calm. You can wait for the day the Fed finally says something explicit enough to make everybody understand the trap. Or you can do the harder thing. You can admit that the trap is already visible in numbers. You can admit that the quiet liquidity is already a clue. You can admit that oil, inflation, debt, and politics have boxed the institution into a place it cannot describe honestly. And you can position for the phase transition before the market finishes broadcasting it to everyone else. That is the threshold, because gold does not wait for public permission. It moves when the mathematics become undeniable to the investors who are paying attention. That is the mirror. Look into it carefully. The most important thing this Fed meeting revealed is not what policy was announced. It is that policy itself has run out of clean exits. And once the market knows that, the next phase stops being a theory. It becomes a repricing.